Good morning, everyone, and welcome to today's 30-minute webinar covering the topic of creating comp plans for employees based on business goals. My name is Summer Ray. I am the marketing coordinator at Signature Analytics, and I will be your moderator today. Before we get started, I'd like to go over a few items so you know how to participate in today's event. You should see in the right side of your browser the attendee interface. You're listening using your computer's speakers by default. If you prefer to join via phone, click on your settings icon and select phone call, and the dial-in information will display. For questions, you can submit them by clicking on the questions icon and typing them into the questions box. You may send in your questions at any time during the presentation, and we will address them during the Q&A session at the end. This session will be recorded and available online for later viewing. Now that we've covered the housekeeping items, I want to introduce Jason Kruger, President at Signature Analytics. Jason is the President and founder of Signature Analytics. He has more than 16 years of accounting and finance experience in both public and private industry accounting. Since 2008, Jason has served as a CFO for many of Signature Analytics' clients, providing them with the financial analysis they need to grow their businesses. Jason will now lead today's webinar.
Thanks, Summer. Okay, so I guess we're here to talk about aligning employee incentives, comp plans, and aligning them to your business goals. With the overall theme, I think, of driving growth and profitability to your business. That's what it really comes down to. And so you'll hear me talking a lot today about the alignment of goals and as business owners, what do we want out of our business? What are we trying to achieve? And what is the end result in the long term? And then also, how do we get there by taking steps in the near term to meet those long-term objectives? So when we look at businesses here at Signature Analytics, we usually start with that question, that allows us to dive into the business in a number of different areas. So we'll talk about obviously where we've seen a lot of businesses and the reality of those businesses, where they currently stand in their comp plan, in how they currently compensate employees and motivate employees. We'll talk about certain symptoms that impact the growth and the profitability associated with how employees are motivated, and then we'll also follow these steps. We'll follow the steps that we talk about here to align employee compensation to the business goals that we're discussing. So the reality for many businesses. I like this little graphic. Obviously you have two individuals, they're very loyal, but their goals are not in alignment. So if you can see the implications of having goals that are not in alignment on a football field, the same is true when you look at your business. So I think, as I mentioned in the previous slide, the first question that business owners want to talk or ask themselves is, what is the true goals of what they're trying to accomplish with their businesses? Are they looking to maintain their business for a long period of time? Are they looking to exit their business? Do they have an exit plan? Are they looking at exiting in the near term or in the long term? Based off of that, if they are looking to exit, should they be focused on the overall value of the business? What are the implications of what drives value to the business? Would that be revenues, or is the value driven by revenues? Is it driven by a percentage or a net income percentage, or what we call EBITDA in a lot of ways? Those are things to consider as you set the goals for your business. And then based off of that, we want to incentivize our employees to be in alignment with those goals. So they're incentivized to focus on the areas that are important to the business. Meaning, if you want to increase revenues because you're looking to sell your business and in multiples based on revenues, then the incentives of the employee should be focused on driving revenues. In other cases, the incentives may be to drive profitability or increase in margins or gross profitability. And those can be two different things in a lot of ways. So it's very important to understand what you're trying to accomplish and then align those compensation plans with those goals. And that's not just with the sales team, but also with the rest of your core employees as well. And we'll get into that a little bit later. So as we look at some of the small and mid-sized businesses, we want to talk about some of the symptoms that we see in a number of these businesses. The first step in that process is obviously incomplete, inaccurate, untimely accounting records. If a company does not have accurate accounting records, it's very difficult to measure any goals that we establish. We want to develop metrics that are tangible and can be measurable on all aspects of our business. That includes not only the financial metrics of the business, but operational metrics and other metrics that we can measure so that we can hold individuals accountable and incentivize them to meet the goals that we're looking for. So the accounting records are the first step in that process. Having timely and accurate financials is imperative to that process. The next step is that there's no strategic financial projections. So we talked about this a little bit ago. If you have no goals, you're not able to project out what your expectations are for the company, and therefore there's no direction that each of the employees are focused on, and as a result, individuals and employees may be moving in different directions because there's no plan that's laid out for them. We see in a lot of cases we see bonuses tied to feelings and a job well done versus aligned to specific metrics, especially when it comes to sales goals, and sales reps are very important in this as it relates to this subject. But even the accounting team, the marketing team, we'll get into that a little bit. Instead of just thinking, hey, a job well done, how can we how can we develop specific metrics that incentivize our employees and then compensate them when they meet those metrics or meet those goals? We should always be looking to incentivize people in a positive way and not a negative way, which we'll get to as well. Good versus great behavior is ill-defined. We want to incentivize people to be great in our business, and we want great people wanting to work with us. So if we are rewarding our A players and we're setting goals and expectations for them, and they're feeling that they're being rewarded appropriately, that's very important. The next one's very important, and it's something that we've actually seen a lot of in our own, I wouldn't say necessarily in our own business, but we're very aware of this. We want to make sure that everybody is in alignment and on the same page as far as the direction of the business, and that they're feeling that they're trusted in what they're doing, and that we can provide clarity in the overall goals of the business and what we're looking to accomplish. So this comes down to the cultural aspects of the business. Management, from our perspective, it's very important that management is very clear and provides clarity in a number of different ways with their team. It may or may not be associated with the financials of the business. I know that there's different aspects associated with that as it comes to sharing that with employee and personnel, but other aspects of the business that there's much more positive in showing certain aspects of the business than not looping in the individuals and creating a team and a goal-oriented atmosphere. Employee apathy. Again, if everybody's grouped into the same pack, A players are rewarded the same as B, C, and D players, it decentivizes those A players to be exceptional, and it also does not incentivize your B, C, and D players to be exceptional as well, because they're happy with the status quo. And the last item, obviously, is the departmental blame and finger pointing. This leads to dangerous direction for the business. We want everyone to get on the bus. We want everyone to be involved in the decision-making process. So how do we do this? I like this little graphic because it actually focuses on the fact that you may have everybody in the room, everybody may be the best player on the team, but if you don't have a common goal outlined, you're all going to be moving in different directions. So you may have an orchestra or you may have a football team. In the case of a football team, you may have the best players on the field, but if you don't have a defined play call, everybody's going to run in their own direction. You're not going to be as effective as if you do have a good plan and a play call in place. So now let's talk about improving the quality of your financial and accounting records in anticipation of developing those compensation plans. So this is extremely important as we talked about before. The first step is before you even define some of your goals, the first step is let's make sure we have a good starting point to get started with. The most important aspect of this whole process is to develop a process to produce timely and accurate information on a consistent basis. So here's some key activities that I'll drop down here that impact that. But when it really comes down to it, there needs to be a process, and it needs to be streamlined and effective for the company to produce timely and accurate financial information. And it needs to be presented in a manner that is measurable, that is easily measurable, and in which company management can use that information to develop metrics to incentivize their teams. And that's very important. If the financial information of the company is not accurate or not trusted, you may be incentivizing your employees on metrics that damage the business. They may not be fair to the individual because the metrics may not be calculated appropriately. And so that can be that's a very important aspect of the business. The next step is determine your top 3 to 5 business goals you'd like to achieve. I actually like to start from a high level before even step number 1 of improving your financial status is understand what you want to do with your business from a long-term perspective. This should be done, at the time you start your business. It should always be evolving, but should be continuing. You should have that continued focus on what that is. After you've been able to improve and streamline the financial processes of your business, then you can start to develop those short-term goals. Those short-term goals should be in alignment with the long-term goals of your business. So if you're looking to sell your business in 3 to 5 years or exit your business, and you think you need to have a certain level of revenue, margins, and EBITDA associated with at that time of sale, what type of growth or what type of improvement of your business do you need over the next 3 to 5 years to meet those objectives? So step 1, if as bullet 1, increase 2017 revenue by 23% from 2016. Let's say you're looking to, over a 3-year period or 5-year period, looking to increase your business by 100% or double or triple the business size. Well, the first step in that is to increase by 23% in the first year. And we'll talk about how we can achieve that and measure that as well. Another business goal may be to focus on the margins of your business. And this bullet says across all product lines, but I think it's also important to understand each product line specifically. So you may have some product lines that are more profitable than others. Some may be able to increase, some you may not, but it's important to understand the margin of each of your product lines so you can impact the bottom line most effectively. Reducing manufacturing scrap to 1% of inventory, and achieving a high customer satisfaction rating for all clients. So these are all examples of goals that you can set. You can set as many as you want or as little as you want, but I think it's important. Obviously, you don't want to get inundated with as many goals as you can't keep track. So it's important to have a nice balance of the goals and how they apply to the teams that have an impact on those goals. So obviously, all of these goals relate to different aspects of the business, but they can all relate to the same business as well. The next step in the process would be to build employee and develop employee compensation plans that are aligned to the business goals that we developed. So if our goal, as we show on this slide, is to produce 65% gross margin across all product lines, across all departments, job functions, regions, and more to drive the right employee behavior. So if that's our goal, what type of compensation plans can we develop not only for our sales team, not only for our production team, but for marketing, accounting staff, etc. So let's walk through that. So if the accounting staff, if we want to produce 65% gross margin across all product lines, we need to be able to have real-time or very effective, timely, and accurate financial information. We need certain reports that we can use to develop those, and track that metric over time. The sales team needs those reports. The executive team needs those reports to make sure that they're meeting and increasing those goals. So one of the examples would be to develop an average product cost and overhead rates for all products by a specified date, and that can then be updated over time. Produce weekly gross margin reports by product, by customer, and by sales rep, and distribute that to the sales team every Monday. So that ensures that the rest of your team is being supported appropriately and getting the right information in their hands to be effective from the accounting department. The sales reps need to have this information so they can track their success and how they're doing against their goals. As we shift down to the sales rep, they may have a certain goal, or their compensation plans may be tied to increasing the gross margin for certain product lines. Now that's a very vague comment, but there may be ways that we're selling certain product lines that we could consider improving. I think having clear financial information on the margin by product line will allow you to understand what product lines there's more demand for, how products are priced. Also developing sales commission models based on gross margin targets versus revenue. So if your goal is to focus on the margin and not as much on the revenue side, well then the sales team should be in alignment with that. We don't want them selling large revenue items or products, or we don't want them driving high revenues if the margins are very low, because that will have a negative impact on our business potentially in a number of different ways depending on the industry you're in. If your industry is based off a multiple of EBITDA, which is impacted by margin, we want to maximize the margin in a lot of ways. If the business is impacted by, or the valuation of the business is impacted by the total revenue, well then margin is not as important, and you want your sales team selling as much as they can, and margin isn't as important. So that's extremely important, that the sales team is in alignment with what they're selling at the margins that are specified and goals we're trying to achieve. Commission ladders that increase commission paid as more sales are achieved. That could be, there's a number of different ways to do that. And obviously, it's extremely important that the company is paid by the customer. And to align sales commissions with the payment is actually a very important aspect, and it helps sales. It actually helps the customer service process as well. When the sales individual is in alignment and creates a relationship with the client or customer when they're selling a product, if they can stay involved from a high level and touch base with that customer or client over time, they bring a different perspective of oversight to the customer, and they should also be able to support the collections process as needed. There's obviously limitations on that. Sales management team. So a goal may be to increase gross margin for X number of product lines or X product line by 20%. Require and enforce that all contracts below 55% margin require director of sales approval. So this provides an additional cap on hey, how low can we go here? We don't want our team selling 40% margins. We don't want to even give them the ability to do that unless they talk to us about that. We'll certainly do that if it's a strategic reason, but let's have a discussion about it. And develop incentive compensation model based on revenue targets, gross margin dollars and percentages, building a ladder that pays more as gross margin goes up. So that's another way to incentivize a team would be to incentivize based on gross margin as you are able to produce additional, or as the margin increases, commissions will also increase as well. And then the last item on the marketing team is to ensure that we're all in alignment. We want to drive a certain number of leads per week across product lines. Marketing team should be incentivized by that. There should have bonuses around that, and it should be something that's measurable. Setting up 50 meetings, phone calls per month for the sales team for potential prospects, depending on the industry that you're in. Increasing percentage wins by marketing from 15 to 20%. So all of those can be things that are measured. If you're able to measure something, you're able to understand what's working, what's not working, tweak the process a little bit to improve results. That's extremely important to be able to measure that information. So then, how do we incentivize repeatable behavior? As we mentioned here, there's always activities that have to be performed consistently to achieve business goals. Oftentimes they're subtle in their impact, but without these in place, ripple effects can occur. So how can we do this? I'm a big fan of positive reinforcement versus negative reinforcement. We don't want to be putting names on the wall of people that are not meeting expectations, but let's put names on the wall per se for people that are. Let's reward the right people. And let's get everybody excited to meet those same expectations and same goals. So in the first example, required behavior. This is very important for a professional service-based firm like we are. Time entry is obviously very important. So to incentivize, we want to make sure that people are meeting those expectations. So part of the bonus compensation plan would be to include time entry as part of their overall bonus. If they're not submitting their time on a timely basis, they would then not meet that level of expectation. But to have that as an incentive as part of the overall bonus ensures that the time is being entered timely and accurately, and we're able to generate our internal reporting as a result of that. From a marketing perspective, let's make sure that the blogs are posted consistently. One of the things that we find in a lot of businesses is that the follow-through is very challenging. So we develop great ideas, we do things a couple of times, and then we don't follow through on it. So if we can create incentives for our team to follow through on, they can be included in the evaluation of the employee and of the department. We can make sure that those incentives are met, and the team then gets a bonus and paid as more on it as a result. We know that if we're able to produce blogs every Monday, Wednesday, Friday, for example, we know that that will drive more revenue. So we're more than happy if we're able to meet that metric to pay our individuals more as a bonus as a result. Days sales outstanding, how can we support the sales, improve the collection process, and what is that, how can we measure that? Again, all of these metrics should be measurable so that we can track that, and it should be tied into the compensation plan of the individuals involved. So that's the underlying theme of this entire webinar, is making sure that you can create repeatable behavior that is trackable through metrics that focus on the goals of what you're trying to accomplish with your business. And these are just a number of different examples that we can that I'm walking through here. If you have manufacturing, scrap can be a very high cost, can really impact the cost associated with the company. If we can reduce scrap by 1 percentage point from 4% to 3%, that could have a very large impact on the bottom line of the business. 1 percentage point on the gross profit or gross margin of a business can have a very significant impact. It could be in the thousands, it can be in the tens of thousands, hundreds of thousands, depending on the size of the business. But 1 percentage point, if you just do the math on your business, take 1% of sales and drop that down to the bottom line. It either goes in your pocket or it goes back into the business to reinvest in the business. And if we can focus on that 1 or 2 percentage points to improve your business, then and we can incentivize your people to get there and pay them accordingly, you're going to have a very healthy and well-run business. So in this case, the measure, the first pass yield by worker, that's more of a scrap percentage. So if you can identify by worker the scrap, the percentage of scrap that individual is generating, we can then focus on that and reward good behavior for those that meet the threshold that were developed. Month-end close process. Getting timely and accurate financial information is imperative. So if we can promote this to our accounting team and we can get the reporting that we need to be able to make the right decisions for our business, to improve our business and make and create action plans against that, that's imperative. So if we can close the books for this, in this example, by the 5th day of the month, we can take a look at our metrics, we can and through that better understand and make decisions on our business real time. There's nothing more important than that. So that wraps up our webinar for the day. Hope we were able to provide a lot of value associated with that. We're going to hand it over to Summer right now, and we'll take any questions.
Thank you, Jason. We're now going to begin the Q&A session and answer the questions submitted. Attendees, you can still submit questions by clicking on the questions icon and typing them into the questions box. Jason, our first question is from Jesse, and the question is, for sales reps, is there an industry standard as it relates to the percentage of total comp being allocated to commission versus base pay?
Yeah, that's an interesting question, actually. We come across that a lot, and the answer, as it typically is, it depends. It really depends on the company and the industry that you're involved with. But from a general rule, I would say that the higher commission that an individual is earning as a percentage of their total overall comp plan, it should equate to higher upside for the sales rep. So if a sales rep is 100% commission, their upside, in other words, what they can earn in general, should be higher than if you have somebody that's higher base percentage. So higher base would equate to lower upside, and a higher commissionable amount should equate to lower, higher base should be lower upside, and a higher commissionable amount should be greater upside. And at the end of the day, it's important to not only determine the impact that a sales rep will have on the business if they do well. So, for example, maybe the sales rep has the opportunity to make $100,000, $150,000, $200,000 a year. What is the impact of that to the business as it relates to revenues, margins, and bottom line, and is it worth it? But I think it's also important to understand the impact on the business when a sales rep is not performing to expectations. You're obviously more protected with a higher commission percentage, so you want to do the math and calculate what the impact that may be on your business if your sales rep is not meeting expectations. You want to make sure that the business is well protected, but at the same time you want to make sure your team and your sales reps are incentivized as well. So there's a lot of factors that go into that, but I'm happy to talk about that offline as well.
Thanks, Jason. Now that we are close to our webinar end time, we're going to respond to any unanswered questions after the webinar. Thank you everyone for attending today's webinar. If you have any other questions, please contact info@signatureanalytics.com. Once you leave today's webinar, you will receive a survey on the presentation. Please complete it. We look forward to your feedback. On behalf of Signature Analytics, thank you for joining us and have a great day.